If you've been following me on Facebook or any of my other social media platforms or subscribing to my email newsletter, you'll know I've been raving recently about the fact that we're getting 1,000 individual views a day on the channel, and it pretty much blows my mind that there are 1,000 different people out there watching these videos. I'm overjoyed with the fact that this is so popular. I mean, I know it's nothing in the grand scheme of YouTube. You know, there are people picking their nose and getting millions of views out there, and this pales in comparison to that. But for little old me, this is pretty awesome. Hey there guys, welcome to the FTSE Show with me, Chris Chillingworth. This is the show where we dissect FTSE companies, only the UK companies right now, although we have plans to do other countries in the future, probably 6 months time, something like that. But for now, we're looking at the FTSE companies, and we have analysed, me and my small team of people, because it takes a team to get through this many companies. We've analysed 341 companies so far. We've done the FTSE 100, the 250, the small cap, the FTSE fledgling, and we've just started doing the FTSE AIM markets, of which there are about 700 companies in there. So it's going to take us some time. And it has taken us some time to get to where we are with the 340 companies that we have looked at. Of those 340 companies we've looked at, we have found 43 companies that meet my criteria of what I'm looking for in a company that I would want to invest in. I'm looking for long-term, 10 to 20 year companies that I can buy those stocks and I can hold them for 10 to 20 years and continue to add to them over that time. Safe in the knowledge and the confidence, I should say, that the odds are very high that those companies' share prices are going to go up considerably over that period of time. So I'm not looking for companies that necessarily are dividend stocks that are paying high dividends but really don't go anywhere in terms of share price. I'd rather forego the dividend and get the share price growth. That's what I'm personally looking for. I know there are other ways to invest out there. I know dividend investing is a big thing. I know the dividend investors get their feelings hurt quite considerably when they watch these videos, and I don't like the stock that they've picked because it's got a high dividend yield but poor share price growth factors. So, you know, you just got to bear that in mind, I think, going forward. Today, we're going to look at a company that has been consistently over and over again requested on this show in the comments of the previous 30, 40 odd videos that we've done on this series. Today, we're going to take a look at a company called IAG, International Consolidated Airlines Group, I believe they're called. Let's take a look. Okay, let's take a look at International Airlines Group PLC then, Epic code IAG. These guys are in the FTSE 100 and obviously in the travel and leisure sector. So straight away, revenue growth is pretty much obvious there every single year. We've seen some growth here going back all the way to 2010, which is when our analysis started. They were sitting at 7.8 billion in revenue coming in. The following year, 2011, 16.1 billion, so a massive jump, almost doubled. In fact, they did double. And 2012, 18.1 billion, rose every single year. And then 2015 to 2017 kind of stayed flat, 22.8 billion in 2015. 22.5, then back up to 22.8. So those 3 years, we didn't really see much revenue growth. And then 2018, it's gone up to 24.2. And then 2019, the most recent report that's been out, is 25.5 billion. So, you know, you're looking at easily pretty much a billions growth a year. So that's pretty astonishing and great work on behalf of this company. The expenses, we would expect the expenses to rise with the revenue. And the best way of measuring that is to look at the ratio of expenses against revenue. And as you can see from the numbers, if you're watching the video here, we've actually seen the numbers go down, which is really encouraging. So 2011, we're looking at 91.2% of the revenue being eaten up by expenses. Then we pretty much stayed there. 2014 it went down to 89.4, then down to 84, then down to 83, where it stayed for 2017. 2018, it went below 80 for the first time, 79.7%. We've gone back up a little bit in 2019, back to 81%, but if you go all the way back again to 2011, where it was at 91%, we can pretty much argue that over the last 10 years, it's fallen from 90% to about 80% in terms of the expenses on revenue. So that's great. It means revenue's growing. Obviously, the expenses is growing with that, but not at the same rate. It's growing at a slower rate, and now only makes up 81% of the revenue, which is great. That's a very positive movement, especially over a long period of time. If it was just 1 year, you could argue it's just a flash in the pan, or something happened, or it's just a lucky year. But to have that consistency of expenses dropping over that long period of time is really encouraging, because what that essentially means is that there's more money left for potential profits, but it could be eaten up elsewhere, and that's what this analysis is all about. Depreciation is pretty much, it went down, it's come back up again. So we're looking at back in 2010, depreciation and amortization costs cost the company 8.5% of its gross profit. That fell down to about 5% by 2013, where it stayed at about 5.5 to 5% until 2018. So a long period of time there, it just stayed at that level, growing with the revenue, but only making up 5% really of the gross margin. And then in 2019, it's jumped back up to 8% again. So a little bit of an increase in depreciation and amortization costs in 2019. So interest on debt cost in 2013, 59% of the gross profit. That fell to 22.9% in 2014, down to 14%, down to 10% the next year, then down to 6%, down to 5% in 2018, and then, that's great. That's all been falling from 59%. It's fallen quite significantly over 6 years. Unfortunately, in 2019, it's jumped back up to 12.8%. So not only have we seen the depreciation costs increase by a good 3% or so, but we've also seen the interest on debt jump up by about 7 or 8%. So that's going to have an impact certainly on the bottom line. Looking then at the net earnings of this company, historically speaking, they've not been fantastic, but they've not been awful. So back in 2010, you're looking at about 3%, and the same for 2011, so a 3% margin. Now that's way too low for me. That's too tight a margin for me, but it's not awful. It's not atrocious. It's not terrible. It's okay. But it's kind of below average, I would say. I'd say 5% is kind of average, really. And even at 5%, I'm not particularly interested as an investor. I want to see bigger margins than that in any company that I'm invested in. But 3% in 2010, 2011. Then they had a losing year in 2012. So they lost 4.1%, negative 4.1%. That was a £742 million loss for shareholders in 2012. Despite the 18 billion coming in, they still the expenses were far too high, and that's what really ate up most of that. Then in 2013, they got back to profitable ways, just shy of 1% margin, 1% profit. And then it's been increasing. So from 2014 onwards, we've seen some much better numbers. And this is, I think, reflected by, or it's impacted by the reduction in interest on debt, and also the reduction in expenses, of course, plus the growth in revenue. All of that equals more money for shareholders at the end of the year. We've seen in 2014, it's gone up to 5%, just shy of 5%, which is, like I said earlier, it's kind of average. Then we've hit 7.5% in 2015, up to 8% in 2016, 9% in 2017, then a fantastic 12% in 2018. Unfortunately, for 2019, it seems to be a bad year for this company because they've fallen back down to 6.7%. Now, it doesn't make them a terrible company. 6.7% is just average. They went from a really good 12% year in 2018, and it was the first year of that kind of caliber of profits, where they made 2.9 billion for the shareholders, and then that was dropped down to 1.7 billion in 2019. So nowhere near as good a year in 2019. Everything moving up and going great from 2014 to 2018, but then 2019 comes along and it just doesn't look as good, unfortunately, and it's kind of hampered the numbers a little bit, and the growth and that trend that we were seeing of everything going up has taken a bit of a dip down, and it'll be interesting to see where that goes from here. Looking at the balance sheet then, the balance sheet looks relatively healthy. Current ratio of 0.9, that means that current liabilities are pretty much at the same level as current assets. Current liabilities at 12.7 billion, current assets at 11.3 billion. So there's about 1 billion more in liabilities than current assets. Cash strong, they've got 4 billion in cash, which is great. We like that. Cash-rich companies tend to be able to adapt quite quickly and quite well to any changing situations. If we come down to what I always like to look at, which is the debt levels, short-term debt sits at 1.8 billion, long-term debt 12.4 billion. So we can add that together and we can say here we've pretty much got about 14 billion. Now, I'm going to just type this in and overwrite this quickly just to kind of see what we're looking at. We're looking at about 8 years based on the formula in the spreadsheet. So we're looking at 8 years of debt repayments, which is a bit high for me. I'm not liking that. That's not what I'm interested in. So there's a company that's making 1.7 billion a year for shareholders in profit, and they've got 14 billion outstanding in debt, which is going to take them, based on their earnings power, about 8 years to pay off. And that's just a bit too much for me. I feel like they're biting off more than they should be, based on the earnings power of their business. And that's a very high debt level. It's the highest it's ever been since 2010. As you can see, back in 2010, they were running at sort of 4 billion in debt. We went up to 6 billion in debt in 2014, then 7.5 billion. Then we kind of dropped down in 2017 and 2018, where they've obviously paid some of that off. But then it's doubled. 2019, the debt level has doubled, and that's quite a considerable jump of 6 billion. So there may be some sort of acquisition going on there, perhaps. I'm not sure. I haven't read all the annual reports to really get a backstory into this company. If you guys know what this company is all about, or if you understand any of the story underneath some of these numbers, please put them in the comments. I get every now and again, I get somebody who mentions, you haven't done enough backstory research. No, that's true, because I only do the backstory research on a company that meets my criteria. Otherwise, I'm literally wasting my time looking at a company that I'm never going to invest in. It would be a way, there's too many companies out there. There's like thousands of companies out there, and over 1,000 companies in the FTSE indexes, if you include the AIM markets. There's no way I can look at the backstory in fine detail of every single one of those companies. I just don't have the time. And so I reserve that analysis, that in-depth reading every single annual report for the last 10 years kind of analysis, for only the companies that meet my criteria. And already I've got my hands full with just the 40-odd companies that I am interested in. I'm not going to be doing it on companies that I know do not meet my criteria. And unfortunately, this is one of those companies that don't meet my criteria. But there are some of you out there watching this that know a lot about this business and know a lot about what's going on underneath the hood here. So if you want to share that, if you want to kind of enlighten me and anyone else, please put some information down in the comments as to why debt levels have jumped from 6 to 12 billion just in the last year. There must be a reason for needing to borrow quite so much. Then we can come down to retained earnings. Historically, retained earnings have not been a pretty sight. From 2012, just kind of snapshot, they were down 3.5 billion down. So there was a negative retained earnings figure. And then it didn't really recover until 2015, where that fell to minus 1.5 billion, stayed there for a couple of years. Then a big jump in obviously increasing that retained earnings pot by negative 384 million. And it is until 2019 where we've actually started to see the retained earnings figure go back into the black at 560 million. So for the first time since 2010, retained earnings going back into the black and back into a positive figure, but historically speaking, it's not been a pretty picture. There's obviously been a lot of effort by the company to increase, because if you look at it in a positive light, 2014 they were down minus 3.3 billion. Now they're up $500 million. So there's been some significant, over the last 6 years, there's been some significant progress in improving the retained earnings, and it's been done successfully. And if this was to continue, then they could very quickly jump into a much higher amounts in there, I suspect, if the business continued to do well. Obviously, 2020 needs to be taken into account with a company like International Airlines Group. We know the airline industry has been hit hard by the events of 2020. Return on shareholder equity is looking pretty strong. One thing that I missed is I just wanted to look at the equity of the business. This is the assets minus the liabilities. And as you can see, there has been some not so much growth in the last 3 years. We were at 3.7 billion in 2014, up to 5.5, stayed there for 2016, and then in the last 3 years we've kind of been stuck at about 6.8 billion, and it's where that stands now. So the last 3 years, the company hasn't really grown in terms of equity, yet the debt levels have gone up, obviously. And that's pretty much it. This company are a very big spender when it comes to capital expenditure, 3.4 billion on purchase of property, plant and equipment. Again, that's a bit of a negative for me. I'm not keen on companies that have to spend huge amounts of money on property, plant and equipment just to compete and just to achieve what they can achieve. Overall, International Airlines Group looked like a decent enough company. 6.7% profit for 2019. It's very average. When you're looking at all the companies across the FTSE, 6.7% is up there in sort of the top 25, top 30% of companies, but it's still not good enough for me. And they're probably going to struggle on the leaderboard a little bit. Let's take a look at the chart. Okay, so the monthly chart going back to 2010. Back in 2010, we were sitting at a price of about £2 a share. We saw it fall to £1.60 a share across 2012, and then quite some considerable growth from about 2013 onwards, where it's carried on going up to, as you can see here, this is 2015 up here, up to 2017 here, reached its peak in August 2018, where it sat at about £7 a share, and then it from August 2018 down to August 2019, so over that year it fell, and this is well before 2020 obviously. This fell from £7.20 a share down to £4.20 a share. I'm not sure why that was, because the financials didn't start to look poor until the results came out of December 2019. So just prior to that, when we probably had this earnings report in August 19, the results looked a little bit poorer, but price went up, which is interesting, always interesting. Then obviously 2020 came in. They started doing badly from the very beginning of the year, from £6.30 to £5.70 in January, before any of the events of 2020 kicked in. And then as those events kicked in, we saw the price fall all the way back down to the same price they were at 2010. And in terms of recovery since then, it's been poor because of the effect that this particular incident in 2020 has had on airlines. And you can understand why this company have not bounced back quite to the same extent as other companies have. It'd be interesting to see how the airline industry recovers from this, and how things are going to look going forward. But as a shareholder holding over the last 10 years, you probably wouldn't be that particularly happy to see all of those gains wiped out, unfortunately, by this event. There's scope obviously for them to recover from this if the industry and if the airline sector can do well. But here's the chart, here's how it looks. Currently sitting at £2.59 a share, which could well be described as a bargain for a company that are relatively average, were priced at about £7 in 2018. Obviously 2019's numbers have been a drop, but they're still not bad. They're still not terrible numbers, they're just average. That's all I can really describe, and I think this company are going to be kind of middle of the leaderboard sort of company. Let's go take a look. Okay, so a few facts to add on to that analysis that we just looked at. So first of all, price today, at time of recording, sits at £2.60 a share. That is an astonishingly low price for the size of the company and what you get for your shares. Earnings per share, 84 pence a share, first of all, as of the last annual report that came out. So what that's telling me is that, and this is one way to price a company, if you were to look at buying all of the shares in this company, all the outstanding shares, of which there are about 2 billion, for £2.59 a share, the earnings per share that you would be getting at 84 pence would give you a 32% return per year on your investment. So that would indicate fantastic business, right? Any company where you can get 32% return a year on your investment is a fantastic opportunity. So that's suggesting that the price is at steal right now. Another way to look at it as well is, what kind of assets do we get for the shares that we buy? Well, the assets per share, or the equity per share that I should say, is £3.40 a share. Well, we can buy them at £2.60. So straight away, you are getting a fantastic deal. I'm calculating here based on the way I like to calculate price analysis, and I know there are many, many different ways of doing this, but the fair price that I'm putting on this company is about £8 or £9 a share. In other words, if this company was priced at about 8 or 9% and they did fantastically and passed all my financial hurdles and criteria and were a company that I'd want to invest in, then I would pay £8 or £9 a share and still be happy that I'm getting a decent deal. The price today is at £2.60. So, another fact to bear in mind is the fact that the dividend yield is 10.5%. Now, I don't know if they've stopped paying dividends, because many companies have in 2020, but this is a company that historically were paying a big dividends. This is definitely a dividend stock. So what you've got here is a company that's in a high-risk situation right now. They're in the airline industry, of course, and we really don't know what's going to happen with the airline industry going forward from 2020. But I'm a long-term investor. I'm a long-term 10 to 20-year thinker. Are airlines going to be okay in 10 years' time? Of course they are, right? Yeah, I mean, the way I like to work it out is like the financial crisis in 2008 was a big deal. People thought the banking industry was collapsing. It was huge. And yet by 2010, 2011, 2012, most investors had forgotten about it. They weren't really thinking about that anymore. It wasn't at the forefront of their minds or the decision making when it came to investing on the stock market. Certainly by now, it's a long gone memory. In 10 years' time, the coronavirus will be another long gone memory. I think it will be. And I think airlines will have recovered by then. I honestly do believe that. I don't think this is the end of the airline industry. And so I see AIG doing very well in the future. However, the financials were just not right for me. They're not the sort of company that I would want to invest in, unfortunately. So what I'm saying here is that fundamentally, looking at the financials, this is not a company that meet my criteria for the kind of company that I'm looking for. But what I will say is that there is a fantastic opportunity here that if you do like what you see in the financials, if you don't care as much as me about the financials, then you can get an airline stock right now at a steal, at a fantastic £2.60 price. I'm not going to be doing that because I have a very strict set of criteria of what I'm looking for, and as you're about to see, AIG did not meet that. But I am absolutely recognizing and acknowledging the fact that the price is so low for this company right now, and it should be far higher, and it should be around £8 or £9 a share, I believe, in the way I analyze price. And so you've got a great steal here if you're willing to take the risk of picking up a very average business in the hope that you can just make some money on that price going up. Then you've got a great opportunity here, I think. £2.60, and it's worth at least a small amount of your capital just to see what might happen. Obviously, you've got to do your own due diligence and research. But let's get them up on the board and see how they've done on this leaderboard. Okay, so IAG is the EPIC code. These guys have, as you saw in the analysis, were not the standout company that I'm looking for. Like I say, there's great opportunity here, but they just did not make the grade when it came to the financials. The financials were nowhere near strong enough for the kind of companies that I like to personally invest in. And because of that, AIG score a rather average 22 points. Now, let's get them up on the board first of all. Okay, so that brings them up into 19th place on the leaderboard, around the same sort of level as BT. I think they're a slightly better company than BT, even though they scored the same amount of points. But it's a respectable score. As you can see, we're still knocking off these companies off the bottom of the board, and we've lost today BP. One of these big giant companies that everyone seems to love, all investors love to invest in, they're gone. The minus 48 points just doesn't cut it anymore for the caliber of companies on this board. And as we go through future weeks, the caliber of companies on this board is just going to increase and get better and better and better, which is awesome. I'm enjoying seeing that develop and evolve. We've got AA at the bottom of this board now. I think AA might have been the first company we looked at on this show. I might be completely wrong. Episode 1 may have been AA, and we're very close to losing them, unfortunately. But I think 22 points is a very, very fair score for this company. But despite that, the 22 points reflects the financial criteria that I'm looking for a company to meet, that tells me that they've got the greatest odds of growing significantly in share price over the next 10 to 20 years. This company is not a big growth stock. However, their price is extremely low right now, and you get an awful lot for that price. So I would understand if any investor wanted to take a bit of a punt on this particular stock on this occasion. And with a 10.5% dividend yield, and the share price being as low as that, with a 32.4% earnings per share, there's just so much there that looks glorious in terms of the actual price that you can buy it for right now, that I would totally get if anyone wanted to invest in it. Thank you very much for watching, guys. I always appreciate your support. I always appreciate your comments. Please leave any comments down below and say hi if you're a long-term watcher now over the last 40 episodes and you haven't said hi before. Please do. Thank you so much for watching, and I'll see you guys in Thursday's episode. Cheers.